Hello and welcome to LedgerCast. My name is Brian Krogsgaard. We got a special guest today. David Hoffman is with me, and he is a expert. I'm gonna call him an expert, whether he wants to be called that or not, on DeFi. And we're going to talk about DeFi, Ethereum. He works with Bankless, and of course, there's a comp craze going on in the world right now. I want to learn about that. First of all, David, welcome. Thanks for being here. Glad to have you.
Hey, Brian, thanks for having me on. This is really excited. I listen to your podcast basically every episode because it's such a change of pace from like the typical crypto podcasts I listen to. So I appreciate your contributions.
I appreciate that. We try to keep it pretty low key, and it's just one of those things. But I was glad to see that you provided us a critique. I should have looked up the actual tweet, but basically, you said you facepalm every time we mention anything about DeFi. So you're going to come on and talk to us. And before we get to the specifics of what we're going to talk about, give us your credentials and let us know, why you know these things.
Right. Yeah. So the further back we go in like my credentials, for the less and less it becomes relevant. I'm definitely one of those people that came into crypto and started learning about money, finance, economics inside of crypto, not before it. Right. So like my college degree is psychology. So totally irrelevant.
Good for trading though, honestly.
Yeah. Well, yeah, that is true. That is true. Good to know that I'm not a good trader and I probably shouldn't try to become one. Which is why I enjoy this podcast, right? Because I get to lean on people that pay attention to it better than myself. But yeah, so, classic story, 2017 happened. It attracted my attention. I fell down the rabbit hole and started learning about, the conversation around money, what money is, what value is, how value is created, how it's destroyed. And then the different systems that manage and create money. And a lot of my thinking lately has been around like the contrast between nation states and how they manage value and versus these new, what I call digital nations, which in my opinion are basically only Bitcoin and Ethereum. Like at one point in time, maybe we could have considered EOS a digital nation, but that seems to be dying off. And then there's all these like Ethereum killers, which if they are successful, they themselves would also therefore become digital nations. However, as far as I can tell, the only two real digital nations that I see that are out there are Bitcoin and Ethereum. And I call them nations because they are self-sovereign, right? They have their own monetary policy. They have their own defensive system, like the hash power for Bitcoin and the stake and proof of stake Ethereum. And they have their own accounting, right? And so you have to report your taxes to the IRS. You have to report all your assets, and that's because they want to know where all the value is. And Bitcoin and Ethereum, in their own respect, know where all the value is. That's what the whole idea of a ledger is. And so I think we're on this cusp of a paradigm shift from typical nation states to digital nations. And so that's kind of like what I've been paying attention to and unpacking this metaphor. And so when it comes to like my credentials is really just trying to understand these metaphors, understand these correlates, and then turn them into blog posts and writings.
Yeah.
And so for whatever credentials I have, it's the fact that people read what I write.
So you're working on Bankless, and that's a newsletter-driven product. So information-based, where people subscribe, I guess, on a monthly basis through Substack and stuff. And then you do the Point of View Crypto
POV
Pod,
Crypto,
Crypto, where you come from. I guess you would belong more to the Ethereum nation state, but you seem to have a healthy respect, at least for the Bitcoin side of things. And then your co-host is a pretty hardcore Bitcoiner, and y'all banter about, right?
That's a pretty accurate comparison. Yeah. So throughout the progress of POV Crypto, me and my co-host Christian, we went to college together, so we kind of have that relationship, which is really nice, and it allows us to actually debate and deliberate without like going into just yelling and screaming that you would find on Twitter. And so because of that, I've definitely kind of stepped towards the middle, quote unquote. Like I do now appreciate Bitcoin in ways that I did not prior, and a lot of the values that are baked into the Bitcoin blockchain. And what I don't see with Bitcoiners often, and with many people, is they seem to not acknowledge how those same values are also baked into Ethereum, right? And so I claim that Ethereum is actually a lot more like Bitcoin than what Bitcoiners will often give it credit for.
We could probably spend the whole episode breaking that down and arguing and, verbally fist fighting over the differences. But for the sake of this, because I wanted to get into DeFi and comp and everything else going on. But I will say, and I will toss an olive branch across and say, the first thing to really get me excited about crypto was the programmatic side of things through Ethereum. And of course, the rapid price rise that we were seeing in early 2017 from Ethereum. But my very first fiat to crypto purchases were Ethereum, because I was very interested in the contractual side of things, like a trustless contract, and very interested in the programmatic side of a blockchain. And even though I'd been investing for a long time, I never really thought of, investing in Bitcoin as in a currency, just a currency is something I would buy because it would appreciate. Whereas when you're buying an asset like a company, that makes sense that you're going to gain value from appreciation as the company creates value. So that did help me get my initial understanding of Ethereum, and I was drawn to that. Over the years, though, I've seen a variety of reasons why Ethereum has potential, but also I think struggles and in its value proposition. But nevertheless, I'm here to listen, and I like your point of view on that, and that you take a stand there. So what I want to do is first tell me about this transition, because Ethereum seems to go through these phases where it's like, Ethereum is for ICOs, or Ethereum is for smart contracts, or now Ethereum is for becoming your own bank and DeFi. And like, is this just another trend, or is this an evolution out of things that we learned from the ICO era? What's different about DeFi? Or is DeFi another thing that will fade away as it fails to materialize the hopes and dreams of Ethereum people?
Yeah, so that's a pretty common critique of Ethereum, right? And if you want to go even further with that critique, a lot of Bitcoiners would say the centralized leadership behind Ethereum keeps on changing the narrative, because they'll generate a narrative and then that narrative won't work and it'll die out, and then the critique then follows then they'll just think of another narrative to keep on the circus will keep on going. And because the most ridiculous of Bitcoiners will claim that Ethereum is an outright scam, and this is just part of the show. However, my opinion is that these narratives are discovered in the same way that Bitcoin started off as a cash payment system, not a store of value, right? And so these narratives emerge over time as we discover what these things are good for. With Bitcoin, there's not too much experimentation, right? There's 21 million and there's proof of work, and that's basically the whole thing. And so with Ethereum, because it's expressive, it has its own complexity with its own narratives, trying to discover what these things actually are. And so we had the programmable world computer at the very beginning. And then that doesn't, I don't even know what that is. It's this nebulous idea of a world shared computer, which I feel is actually technically true of what it is. And then we had ICOs come in, and that did its own thing. The fact that ICOs needed Ether as its investment currency kind of made Ether this investment bank asset for Ethereum. But then ICOs went away, and now we have DeFi, and now we have these governance tokens being issued. Comp is that, and that has kind of changed the game with DeFi. But instead of each narrative replacing the other one, to me, I just see it layering on top of one after another. Each one stacks upon the innovations of the phases that came behind it. And Robert Lesher, who's the CEO of Compound, who is really spearheading this whole comp token thing, he made this really awesome tweet thread where he goes through the different innovations that other people have made that he basically just used and copied and reformulated to make it fit for the Compound purpose. And each one comes from a different part of Ethereum, right? So the MKR MakerDAO governance system is directly related to Compound. The way that Compound is issuing this token is itself a form of an ICO, but I would argue is a much better form with better incentive alignment. And then there's just the perpetual being able to have arbitrary computation and arbitrary code added to the Compound token. And so like all of these things are found throughout Ethereum's history, and they are now coalescing into what is a real product.
So I'm interested in the governance side of things in the sense of trying to explain to me why it's different. ZRX governance token that's evolved over time and tried to adopt things that help it establish value. Augur, in a way, kind of a governance token where there was they were the deciders on whether an outcome was true or not, right? Mm-hmm. So like different types of governance have been built into tokens in terms of the stakeholders are the deciders of what goes on in the network, but that hasn't always translated to them having value. So when I think about Compound, I'm going to try to explain my layman's view of this, but I can, if I'm a lender, I can deposit USDT and then someone can borrow that from me. But what I get, my interest is delivered essentially in the Compound token, correct?
Yes, but there's missing a very crucial component where I would say actually that's more wrong than it is correct. Okay. You do get the comp token, but the comp token is more of like a cherry on top. It's more of a subsidy when you lend out your Tether or
so I'm
asset.
getting like 8% or something first just because of the terms of the loan, and then I'm also getting comp.
You get the loan. The loan is denominated in Tether, and you receive payments in Tether, and then comp is issued to you on top of that as a reward for participating.
And then people who are borrowing are also getting comp because they're providing.
Yes.
Because the way the comp designers set it up is they are, because they're borrowing, they're participating, and they get a Chuck E. Cheese token in return to say thanks for being here.
Right.
So what determines why there is value in comp, the governance token itself, beyond speculation?
Yeah. So yeah, it's a Chuck E. Cheese token because what you're saying is like, why is this thing valuable, right? Like why is governance valuable?
Anything is valuable because people determine it's valuable, but why is this governance valuable when we've seen other examples of governance fail and teams have to continue to iterate and find value in their tokens? Because you didn't even really need ZRX to run a DEX, or like ZRX was purely the governance side of that token, and there's hundreds of probably of other examples, but dozens of fairly prominent ones of governance tokens where they were reaching to try to find and define what the value is in the governance token. So what makes comp different?
Yeah, I would definitely say that the jury is still out on ZRX as to why it's a valuable token. So I'm totally aligned there. Comp is different because, and this is kind of where the nomenclature of token kind of gets in the way. Like a token, the name token is just like a placeholder for something more accurate or precise about what these things are. And I think if we borrow a metaphor from the old world, what comp is, it's a share of a company, except this company is a digital protocol. And so like governance over a company is represented by the shares in a company, right? And the cool thing about Compound is it has all of these cash flows going through it, right? There's suppliers and there's borrowers and there's a bunch of economic activity that the comp token governs over. And to me, this model is no different from the typical corporation model that we see in the meat space world, like the physical nation world. But since we are now in the digital nation world, instead of these things being companies, they are now protocols. But the token still represents ownership over or say in how the protocol operates. So the reason why these things have value is because at some point in time, it's probably just assumed that these token holders are going to vote in themselves a cut of the cash flows. And so this turns comp token into a capital asset, an asset that produces dividends for its owners, which is just like all the other kind of assets that we see that pay out dividends on the stock market. Right now, I would classify comp as something along the lines of like Netflix or Amazon or Uber, or a share of a company that is focused on growth at the moment. So they are yet to vote themselves into a dividend. But at some point, the whole point of this thing is to generate profits for the owners of the protocol, and the owners of the protocol are defined by who owns the comp token.
Isn't that a very dangerous definition if you're the stakeholders of comp and it's a centralized network and you are based in the United States and the SEC is breathing down your throat?
Okay, so yeah, this is definitely exactly what you guys brought up in the podcast that I was listening to.
I can't get beyond how this is this has to be a security the way I look at it. Like it meets.
Well, okay, so it's not the only way that it becomes security is if they do vote in cash flows, and the idea is that they become decentralized before that happens, right? And so issuing the token as governance over a protocol is not issuing profits based off of a third party. And I'm not a lawyer, and you should not quote me as this.
Yeah, none of this is financial advice or legal advice or any other.
Yeah,
This is just us talking.
But the fact that I'm not a lawyer is probably why I'm free to say this, right? It's like, it's not a security because it would fail the Howey test today. These are not profits based off of a third party. There's no investment contract. These are tokens that explicitly enable the rights to change the protocol of Compound. It's up to the comp token holders to vote in the rights of it becoming a profit-seeking token. But the whole idea is that they're not going to do that until the protocol is sufficiently decentralized, which is why we are issuing comp tokens to the people that use the protocol so we can spread out the ownership equity over Compound.
Yeah, but
I think it's genius.
What about the fact that, a gigantic percentage of these are going to people that are, shareholders of Compound Labs, 24%, the Compound team, 22.25%, future members, 3.72%. You don't get to protocol usage until that's 42%. So for
42%, that's a lot.
No, it's not. For 4 years, A16Z is Andreessen Horowitz is the largest, wallet. Currently getting this distribution of the 2,880 comp distributed per day. This is just going straight into them, and it's like a dividend for their investment. But how did they get a hold of it? How did they get their Compound? They have equity in Compound Labs, and somewhere along the lines, they got the rights to some kind of contract to be distributed tokens and to be the stakeholder. So they have this expectation of profit via the dividend of the continuously releasing comp. Why are we letting them dump on us? And it just reeks to me. Like, explain how that works. Yeah.
So what's important to know is that, like, even all of these individual groups are not one. They're not one set of people, right? So A16 is one entity, but it's made up of many others. And then also the Compound team is the same. And I think Robert Lesher, the CEO, only owns 1%. I don't know if that's true or not. But the point is like the asset ownership is spread out more than what the categories of people receiving the comp token would illustrate. And I hope A16Z dumps. I hope they dump on the secondary market because that will help with the entropy.
Yeah, but they have 4 years to do it, don't they? Because this distribution lasts that entire period.
Well, it would be better if it were 4 years than like 6 months or 1 year, right? We want it to be a longer amount of time to have more entropy, right? And so comp just got listed on Coinbase today, and it's like doing its crazy thing. It's up to like $270, which is more than 1 ETH per comp, which is insane. It's probably going up more though. But like the whole idea is like we do want A16Z to sell into the market. It was their investment in Compound Labs in the first place that allowed this protocol to come about. And if we are concerned that they are holding too much of total comp, I'm not sure how much they are holding, but I mean, no one is holding anywhere close to 51%. So that's important to say. So there is consensus required for any sort of governance decision. But I'd see A16Z as exiting from this like reformed ICO as a very good thing.
Let's leave that there for a minute. To me, this feels like an ICO by another name. Like privileged people have access to the inflation of the asset, and then speculators are encouraged to be the ones to go buy this up seeking returns. And then the privileged people at the beginning just steadily dump their bags on those less sophisticated investors. And to me, that seems like the type of thing that the SEC may look at and say, hey, this isn't adding up right. Mm-hmm. My buddy Crypto Winthorpe, he's dug into a lot of this stuff from the investment side of things and just playing with it. And he's talked about the value of comp in his mind is that they have the ability to vote in or out tokens. So that gets me to one of my questions, because it seems like one of the potential areas of abuse in the current network or extracting additional gains, depending on how you look at it. But we've seen like people kind of corner BAT or corner whatever other couple of tokens that are a little less liquid, a little easier to move. And I guess the governance of the comp token allows you to use different things for collateral. How does all that work into the way this has played from a game theory perspective?
Yeah, so you started off talking about how this is just an ICO in a different form, right? And so I would also like to contrast this with so Compound, Coinbase is at some point going to go public on the public equity markets and have a share on the stock market, right? Like at some point that's going to happen. That's in their plans. Compound is never going to do that because they did this instead. Right. So what Compound has done is they have basically gone public, right? They are now a publicly traded protocol instead of being a publicly traded company. And so as far as the model for how this new ICO is happening, like to me, it's just an ICO is just quote unquote going public. But what Compound did is they did the work first, and now there's the token rather than first there's a token and then there's some promise of work.
My gut just tells me any member of Compound Labs that heard that would be crapping themselves because it's so close to the fringes of legality, at least in the United States.
But like I'm not part of the Compound protocol, nor am I a lawyer, so I get to have that extra like freedom with.
But as a person interested in the ecosystem, mm-hmm. Don't you agree that provides additional network risks that people should at least pay attention to when they consider their allocations to it?
So like the thing that defends against that is sufficient decentralization of the asset, right? And it's the same way, like, okay, if somebody said Bitcoin is a security, what are they going to do about it? Like, what are they going to shut it down? Like, that's not going to happen. It's the same deal. And same thing with MKR and MakerDAO. Like MKR has been publicly traded for a long time. If they wanted to shut down MKR, the only way that they would have to do that is by voting with MKR itself. And so like, maybe like, I'm sure there's legal exposure here. I'm sure the nation state might not like it because they're going public in a roundabout way that makes themselves out of the purview of the state. So yeah, this is perhaps dangerous territory, but this whole industry is a big middle finger to the nation state. and so like this is no different, right? So it's a race for decentralizing the asset, right? Decentralizing comp amongst a variety of people. And as soon as it becomes diffuse enough to where like no one particular person can actually control Compound, then it doesn't matter. Like maybe the teams have legal exposure. Maybe Robert Lesher comes under the eye of the state, and then the state is like, I don't like what you did. But that doesn't actually threaten Compound protocol anymore because governance over the protocol is now out of the hands of the Compound team and into the hands of the comp token.
Isn't that the way they're going about it? Isn't it a little more of an inefficient route than, say, like Uniswap was? Because Uniswap, it was just, there is no financial incentive for the person that created it. They just released a smart contract to the wild, right? So isn't that a more pure model than this?
Yeah. So that's a really good point. So this is kind of what I talk about with Ryan on the Bankless pod, is we talk about the protocol sync thesis, where things that are more robotic, right? Less subjective, requires less governance. Things are just basic crypto economic primitives like Uniswap will tend to be used more than others because of that lack of subjectivity, right? And this is Nick Szabo's social scalability thesis.
So you're saying the subjectivity requires this degree of governance and human involvement.
Yeah. So like the whole idea about governance over Compound and MakerDAO, right, is like there are going to be tokens in the future that we want to onboard into these systems. And also there's going to be a different economic reality in the future that we are going to have to make the protocol answer to, right? Like maybe something happens to Tether, maybe something happens to DAI. Like there does require some amount of nimbleness about how to deal with changes into the future and just to update the software, right? These protocols require software updates as the economic environment around them also changes. And so the governance and Uniswap is neat because Uniswap is it's actually not one protocol, right? And so every single exchange through Uniswap, whether it's ETH to DAI or DAI to USDC, is its own contract. But there isn't one central protocol like Uniswap, and so it doesn't need to update. If more assets come to Ethereum, you can just use the Uniswap factory contract to mint new exchanges. And then that is how Uniswap updates. But Compound is a central protocol where everyone must come to Compound to use it, which means that there needs to be some sort of central coordinator with updates to Compound to make it fit for the environment that it finds itself in. And that's why governance does have, there's no like robot way to do this. There's no robotic way to predict the future.
So when there's still these central decision makers, are we really accomplishing the Bankless goal, or are we just recreating something with buggy code?
So the token is the central decision maker, but it's the ownership, the diffuse ownership of the token that makes it not centralized. So only one thing is allowed to make updates to Compound, and that is the token. But the token ownership could be, a nebulous set of 10,000 people from every single country all over the world that is part of one single digital nation that is Ethereum.
But the access to that token, still, we're giving essentially a bootstrapping fee to a handful of crypto bros and VCs in the first place. Is that just a necessary tax on the launch of the network, or that? Mm-hmm. Okay, so that's just something you're totally.
So like how else do we get these things built and out the door without, like, that is the role of VC funding, right? Is to, bootstrap these things into existence. So we saw a bunch of ICOs.
Sort of, but we've seen Bitcoin and then plenty of other open source software. Of course, they have their own troubles in terms of funding software development, but they've done it without the relative kickback tax.
Right. But that is a value that's built into the Bitcoin protocol. Like, if Bitcoin was VC funded, it wouldn't be Bitcoin, right? It wouldn't be what it is. No. It would be something else. But I don't think Compound has those values baked into the code of Compound. Compound is a money market for borrowing and lending. It doesn't necessarily have a maximal amount of Genesis purity at the start of it that is required to make it a good or bad product. So
why can't I fork Compound and call it some dog pound or whatever? And
you totally can.
So I can fork it. I could take all there is no IP built into this. So
correct.
What stops me from doing so? And then the 100% of the distribution bypasses all the central entities that would gain that token. And it's much fairer in terms of how that goes out. Is there anything that's held back through the IP or through the holdings of these central entities? Because the same as the ICOs that we would run into is like, that's cool. Like, public record keeping on the blockchain, whatever, except for it doesn't seem right when there's this gigantic percentage of tokens that are allocated to these people. It doesn't seem like a public good.
So yes, you can freely fork the Compound code, and we actually saw a team do this. It was the DForce lend f me hack. If you remember.
Oh, is that what that was? Yeah, I saw.
Yeah, they forked the code and then they tweaked it. Except clearly, if you're going to fork the code, you're probably not competent in development, and so they tweaked the code after they forked it, and then what their tweak that they did blew up the system, right? And so maybe that's one reason why you can't just fork the code, because understanding the code requires really intimate involvement with it. But you could fork the code and keep it exactly the same and then reissue the token to be owned by other people. So it would be a state balance update is like the technical term for it.
I'm going to disagree about you don't know what you're doing if you fork it, though, because you never really want to do something yourself if someone's done it before you in the first place.
Yeah.
So it's a bit of a evolutionary thing. Especially, it's very common in open source software for sure to start with a foundation that someone else laid for you, and especially if it's under some open source licensing, then it's dumb to reinvent the wheel in some ways.
Sure.
So there's nothing.
But the real problem,
there's no IP built into the decision making there.
Right. Correct. There's no IP. Anything that's deployed on Ethereum has no IP. You're giving that up. Say you fork Compound and you want to redistribute the token in a more equitable way. First, you have a problem of how do you even do that without people gaming the system? And one way to do that might be doing what they are doing now, which is doing the liquidity mining where you are rewarded for supplying and borrowing. And so that is a way to do this. But then you're going to fight compound network effects where there is already tons of liquidity both from borrowers and sellers inside a compound. And you're going to have to convince that liquidity to move over because that's what the whole goal is. But people are only going to move over if they see that your protocol is meaningfully better, and because of the problem that you are trying to solve, which is the fairness of the distribution of the token. And I would contend that the fairness of the distribution of the con token is pretty fair. It's pretty fair. And when you say like you have these massive centralized owners of the comp token, I wouldn't say that that's represents what's actually going on. Like I don't know how much A16Z has, but I think it's less than 10%, and I don't think anyone actually owns more than 10% individually. And even if they own like 20%, like the point is that so long as it follows a balanced Pareto distribution, a log curve of ownership, and this Gini coefficient is relatively balanced, I think that's fair. Like no one should have 100% of the assets. But there will be people that own more because that's just how the laws of the universe works, right? Some people own a lot, and then a lot of people own a medium amount, and then a ton of people own very little. And I do think that distribution, the Gini coefficient of compound, matches on to what we would find in the real world, and perhaps even better, specifically because of this whole liquidity mining mechanism that they've built in, which is a brand new innovation that you could not have done in the real world.
So let's rewind back to the governance of which tokens are available as collateral. I guess that's where they go. Like you're always borrowing USDT or, okay.
Well, you can borrow or lend it.
Right. But I'm saying in terms of what the token, like BAT being collateral, like that affecting some of the price side of things for our traders in the audience. The governance of the token affects what can be collateral, but is it also about what can be lent out?
Yes.
Like, can I borrow? Yes. Can I use Ethereum for collateral and borrow BAT?
Yes.
Okay.
Yes.
So it's a many by many lending and borrowing collateral.
Yeah. So some you cannot use as collateral, but you can borrow with other collateral. That is a thing. I think WPTC is in that category. It doesn't work as collateral, but you can still borrow it. But again, that can also be changed by governance vote.
Okay, so the things that are available there are adjusted by who's in charge from a governance perspective, or who gains consensus from a governance perspective. What is the game theory that goes into that? How is this played into, like, was BAT an addition, or it was just somebody exposing something that was already allowed? Like, what happened there?
So I think it's following like the MakerDAO system, or whatever. It's no formalized system that they created, but like MakerDAO is voting in these tokens to be collateral inside of the system. And Compound actually did this first because Compound came out before multi-collateral DAI did. But MakerDAO came out with governance before Compound did. And so like the governance stakeholders are voting in and out assets in their system. And this is basically going to be true for any sort of system that receives collateral with a governance token. And then they're going to have to decide what the correct rates should be, the right curves for deciding what the interest rates and the supply rates and the borrow rates, right? And so the supply and borrow rates are flexible. They change as there is more or less demand for these things. But the curve that they change at is what is decided by Compound governance, right? And so MakerDAO has this very strict. Well, it's not strict. It's like a social contract that they govern by scientific data, like scientific consensus. Ultimately, that is still subjective at the end of the day because like you have to have opinions as to what is good and bad data. But this is just the same old problem as like corporations, right? Like they need to make subjective decisions based on data to do what's best for the company. And this is the same thing with Compound protocol. Like the comp holders they are incentivized to do what's best for the Compound protocol because they have the asset that is supposed to appreciate the better that the protocol does. And so that is supposed to incentivize making the correct decision.
So there's been some people starting to report that they lost money or were liquidated from their positions because they over leveraged? Because I think you can essentially recursively borrow.
Yeah, you can get pretty crazy.
Okay, so you can borrow. You can do the initial borrow, establish your collateral, and then take what you borrow, and then go do it again over and over again until you stack up
to a limit. Yeah,
to some degree of leverage. So, what is causing people to get wrecked in this in general? But that scenario seems pretty obvious. Like if they get if the price goes down just a little tiny bit, they're essentially at some significant degree of leverage. But what other mechanisms have been squirreled out or taken advantage of in the protocol or whatever else to where people have lost money in this so far?
Yeah, and people have even gotten liquidated when they borrow and supply stable coins, right? So like in order to be immune from price volatility and getting liquidated because of volatility, people have been doing the same things with stable coins. So like they borrow 1,000 tether and then they also supply that tether, and then using that tether as collateral, they'll borrow USDC, and then they'll supply that USDC. Because the more borrowing and lending that you do, you earn more comp, and comp is like really highly priced. So there's a lot of reason to do this.
So they're essentially working like a market maker would, in a sense, right? Because they're providing
leverage.
But they're providing liquidity on both sides of the book, and then they're being incentivized to do so because almost like, where you have a maker and taker fee. Well, sometimes makers, especially early in an exchange, they're actually rewarded for providing the liquidity on the order book. So this is a similar situation where what they're provided is the compound. Right. So where do they get screwed over if they're in a stable coin?
It's because they will get liquidated if their interest payments increase past a specific number, right? And so what they owe increases because there's interest payments. And so they need to be paying off those interest payments or else they'll get liquidated. And this is just like a learning process.
Okay, so you have to pay it's like missing the actual interest payment like on a regular basis, right?
Well, yeah, but it accumulates block by block, so every 12 seconds. So it's going to slowly creep up higher and higher and higher until your limit, and then you get liquidated at 4%. So only 4% gets cut out of compound, plus a little bit more, and then it'll start to accrue again, right?
Okay.
So your question is like, what's going on here? Like, let's unpack this. A really important point is like, there is attack vectors based on this governance token where like you can vote in to add collateral, you can change the interest rates, you can do things that impact the market, right? And especially like if somebody has like a large amount of comp, they can like nudge governance, be like, okay, let's change the interest rate on this particular token, or let's add this particular token. And they can front run that opportunity, right? Because they are the ones making the change. Let's say like, okay, let's up the rewards on BAT, like, and they'll be the ones supplying BAT, right? And because they know that this is coming, they might do that. This is a hypothetical like attack. You're supposed to be incentivized to not do this because that's bad for the protocol, but that is the centralization risk. That is like the quote unquote like backdoor dealing, corruption.
Yeah, somebody has enough control over the network that they can influence this vote, and then it's made on an asset that is small enough of a part of the overall ecosystem that they can then influence it and screw people over.
Right. So there's currently a governance proposal in Compound to reduce the rewards that are being paid because of how crazy everything has gotten. Like the assets under management Compound has gone from like 100. I can't remember. I think it was like 100,000 to 600,000, or I could be off by like 3 zeros actually. But the point is, it's 6x. There was one amount, and now there's 6x more. I do know that is the correct number.
And this is the most popular thing on Ethereum right now, right?
This is it. And it's not just that. It's because it's definitely the most popular thing to do, but it's really what people like me and my co-host at Bankless, Ryan, what we get excited about is this new token model paradigm that's coming. Like it's indicative of things to come. And so to backtrack, Compound is talking about reducing rewards based on how successful this was. It was a little too successful. There's a lot of mania going on. There's a lot of people like taking risk. And so they want to reduce the rewards of Compound, of the comp token, to borrowers and lenders to like kind of dampen the energy. And then, but the other half of that debate is saying like, well, no, the market needs to settle this out. Let's not like federally reserve this and have central coordination over the market. Let's just let the free market like figure out how to not get liquidated, figure out how to be safe about this. Let's let things play out before we come in hard and fast with a new protocol, a new rule, new monetary policy, quote unquote. So it is that balance left and right.
So why are people valuing the comp token itself?
Because the idea is all these borrowers and lenders who are supplying liquidity, and then the borrowers that are taking that liquidity, they're paying an interest rate. But the idea is that the comp token will take a cut of that interest rate, right? And so if their interest rate is at 6%, they'll pay 4% to the suppliers, and then they will take and pocket that 2% as cash flow to the comp holders.
And so because there's only the 2880 comp per day that are distributed, therefore, if suddenly you have billions of dollars that are being used in this network, then that comp has to be split up a lot. And it's essentially creating some network effects for people just assigning value because this is a large protocol, correct?
Yeah. So that 2,880 comp that is issued on a daily basis comes out of a pool that is 10 million total comp. So like that comp's that's not being minted. It's already been minted.
Yeah, it's been minted, but it's not. It's in some kind of reserve pool somewhere, and it's programmatically distributed every day.
Exactly. But once that pool is depleted, there's no more comp. Like that's it. The comp governance can totally vote in more comp because again, this is just like a normal company, but in the digital realm. But for now, there's just 10 million, and if they wanted to vote in more comp, it would have to be for some reason that is accepted by the governors.
So how do we decide, okay, well, $300 for one comp is too much, if it's more than one Ethereum or,
who are we? Who is the party that is we?
Traders, speculators, network providers, shareholders who want to, you can go, I've got this, up here right now. I can go to FTX and, they were smart to put this market up when this whole thing started happening, but this sucker was at 145 or so when they started listing, and it hit as high as 360 a couple of times. So you're talking about $360 comp. If I'm whatever they're A16Z or whoever else, I want to go lock in my pricing on something like that.
Right.
So you could go and you could short there and essentially secure your value for a long time. I'm running out. I understand this happens in any network. Like, how do we know what an Ethereum is worth or whatever else? But something about this seems a little unreasonable or a little hype driven. If you just look at the low time frame curves of this network, or are we truly seeing growth in this? And it's, such a market leader now. What do you think is playing into all of that?
Right. So like the high price of the comp token is what is generating the incentive for these people to come and supply liquidity, right? And the people that do that are objectively making the protocol better, right? So people that are using Compound for non-liquidity farming purposes, like they're actually taking out a loan for whatever reason, are getting better rates. And there's more liquidity there. So the Compound, as a result of the high comp token price, there's more liquidity, which makes the Compound protocol better. And then the fact that the protocol is better is because it's also generating more liquidity. So it turns into this flywheel thing. But at the end of the day, the free market world should take over, where like $380 comp is kind of ridiculous. Like it's like $1.5 billion. That's a big number, especially when all of Ethereum is like 25 billion.
Yeah.
And so
and how much?
A lot of people are just mining liquidity mining comp just to dump it on the market because there's not that much comp on the market. Like it's super illiquid. A16Z, if they came and sold any of their shares, they would just crash the whole entire system because this market is so young.
Or on somewhere with leverage like FTX, they can deposit collateral so they can, have collateral Bitcoin or USDT or whatever else FTX will accept. And then they can just sell a crap ton, secure their $300 comp for a long time, as long as the funding is either in their favor or neutral. Mm-hmm. And then they are covered and good to go for a really long time with a crazy investment. So the network is, I guess, who decides, well, they don't deserve that. Who else is coming into this ecosystem? Because I guess Compound took off in the way it did because it was a new iteration of this model, especially from
Right.
MakerDAI, and they took over quickly. MakerDAI. Is Maker going to adopt something similar? Are there other tokens that are coming along that are providing similar concepts?
Totally.
What's coming up next?
So Maker, the way that Maker is designed, it won't be able to do this just because there's no way to issue, there's no party to issue the token to. And the token is meant to be actually as deflationary as possible. Other protocols are doing this. Actually today, Balancer just followed up with, and they had this in the works. This isn't just something that is just randomly new. People have been working on this for a long, long time. And it's just now coming into it being pushed out into production, right? And so Balancer, which is like a Uniswap, but instead of 2 tokens, there's many tokens. So they have 8 now. So you can have a pool of 8 tokens, but then that can go up to 16, 32 into the future. And so when you supply liquidity to Balancer, you'll get the Balancer token. And actually, the very first group of people that did this was FutureSwap.
Okay.
FutureSwap, where that they put out an alpha where you could come, and it was basically like DYDX, where you could take leverage on a position based off of collateral. And if you were to do this, you would receive like the FutureSwap version of the comp token. And they had to shut it down because so many people put in so much value on an unaudited contract that they got scared, so they shut it down. And so this is why this is
purely from a security point of view, they hadn't done enough testing on it.
Exactly.
It's like saying you want to put $2 billion on the Lightning Network or something.
Yeah, no, that's exactly right. And so like there have been like these early tremors of this whole mania coming for a long time now. And because FutureSwap was the first actual instantiation of this, they just had it out on alpha or beta, and they haven't redeployed it since because they're still under audit. And so like now we have 3 tokens that are doing this. And I think like Aave is another protocol that I don't think they haven't verbalized any concrete plans, but the way that the protocol is structured, that they totally could, right? And there's this guy, Gavin, I can't remember his last name, but he wrote this article, A Simple Agreement for Future Governance, which is a play off of the SAFT, right? And then also the SAFE. So like in 2017, 2018, when we were going through the ICO mania, somebody made the Simple Agreement for Future Tokens, which is a way to get around the securities world. And then that kind of just got shut down by the SEC because they shut down the Telegram ICO. The Telegram ICO was a SAFT, and the SEC said no. And so now the SAFT is dead. But now there's the Simple Agreement for Future Governance, which is basically the tokens that we are seeing now, right? Where we issue you tokens, and in the future, they'll be able to govern over the protocol.
Interesting. So what role is Ren playing in all this? Because I've seen it going up. It got listed, or it was named in Coinbase's analysis of tokens that they were going to look into. I bought it right around then, and then I've missed a gigantic move because I got scared by the very next day. It whipsawed all over the place. But I knew I had friends that liked this and these dark pools and whatever else, but I didn't expect this, like huge missed opportunity. Is this because of DeFi stuff that Ren is reacting like this? And what role does Ren play in all this ecosystem?
Yeah, so this is both not relevant and relevant at the same time. So this is not a governance token. It doesn't follow the same liquidity mining rules. But what is happening is Ren is a token for getting Bitcoin onto Ethereum in a trustless manner. I personally have not vetted the trustlessness of this system. I don't understand it too well. But if you have Bitcoin, you can get it over to Ethereum in a wrapped form with Ren. And then when you do that, I think it's a fee burn token. So like when you do that, some amount of Ren is burned. There's like a fee for the burning. And there's been a ton of, because you can do this liquidity mining in Compound with Ren BTC, and you can also do this in Curve, and you can also do this in whatever protocol. There's a lot of different protocols that are taking in both Ren BTC and WBTC. Probably TBTC, the project from Keep, would be in that mix if they had gotten out the door sooner. But there's just been a absolute like stampede of Bitcoin from the Bitcoin network moving on to Ethereum in order to participate in this like liquidity mining phenomenon. So Ren isn't one of these tokens, but it definitely is benefiting from the demand for assets inside of these Ethereum applications.
I don't remember who linked this article, but it's DeFiPrime.com. is the one I've been showing up. It's got a summary of some of these, but it's curve, REN, synthetics, combined yield. So people who provide WBTC or REN BTC, which is, this is the wrapped BTC that we're just describing, they could simultaneously earn BAL, ball, is that how it's pronounced? Synthetics.
Yeah, that's the balancer token.
Yeah, the balancer token, synthetics, REN, and curves reward token. So they can submit. And that's, as a person interested in Bitcoin, like that's interesting to me because I'm turning over my Bitcoin to a smart contract. So that's a risk. But by turning over my Bitcoin to the smart contract, now I can earn dividends in 4 of these different shitcoins, for no offense, and earn some kind of yield on lending all that crap to other people to go have a field day with. That sounds pretty cool. What risks am I not thinking about with something like that? In addition to the risk of the smart contract itself.
Yeah, no, there's totally like cumulative risk because you're not trusting one contract, you're trusting multiple different contracts, right? So you're trusting the REN contract to appropriately get your Bitcoin over to Ethereum and then also redeem it on the day that you want it redeemed. So there's some trust there. And then you're submitting it to the Curve contract, which if I remember correctly, it's pretty robust in the same way like Uniswap is, where it's not terribly complicated. So there's not too much risk there, but there's more risk than not submitting it to Curve. And then you submit it into that balancer pool, which has other tokens inside of it. And so like just like Uniswap, when you submit your REN BTC into balancer, you get a token out as a receipt, which is a claim on the underlying tokens in the pool, which means that you have then proportional exposure to all the other tokens in the pool. So like maybe you submitted REN, but then there's also WBTC in there, and then BitGo goes under and says like, okay, all the WBTC is now just some worthless ERC20 shitcoin, and we're not redeeming it anymore. Well, then you have exposure there, but you only have you're only a proportional share of the exposure, right? Because the REN BTC is still in there. So if that was just 1/4 of the pool,
that would be a similar idea to if the Lightning Network failed, right? Because when you get funds into the Lightning Network, technically there's the way that settles and the way it's identified, it's not the same as BTC on the main chain.
Yes, so this is all about redeemability. Like, can we redeem the assets? I bet you Bitcoiners and the Bitcoin developers are spending a ton more time vetting the Lightning Network than at REN. But that doesn't mean that REN isn't also doing a good job with that.
Similar concept, but we have concept. We don't really know what auditing bridging
two protocols like Bitcoin and Ethereum is going to be a lot harder than bridging a Lightning Network protocol that is specifically designed to communicate with the Bitcoin network. So that is something to take into account.
So we're mostly talking about yield farming and like being able to send some stuff over here. Bitcoin or USDT both seem like decent options and attract some yield from whoever's out there YOLOing and borrowing off all this stuff. What's the thing that matters more? Like, this is interesting from a speculator perspective, from people that are, hyper interested in a network. But when we get to the real world applications, I mean, it seems like you have some real estate stuff that you do. Like, how does this matter for the way people may take on mortgages or the way other types of money transfer contract obligations occur in the future, to where we can maybe actually achieve something with crypto rather than just, passing
around some tokens and calling it economic activity.
Right.
Yeah. But that's where it has to start, right? Like, because no one is going to throw their $1 billion house onto the blockchain when there's nothing else there, right? So we have to start with passing around some random tokens and seeing how that works. I would say Compound is a legit protocol, and so is Maker. And these things I think are going to exist into the future. The quality of these protocols really depend on the quality of assets that are available to them, right? And so what we really need is some sort of scalable way to get real world assets onto Ethereum so that you can use your real world asset as collateral in various applications, right? Either as synthetic asset or a direct legal representation of what these assets are. And that's a really big problem because that is spanning these two worlds, right? There's the crypto nation state, the digital nations, and then there's the physical nation state. And these are basically two different languages. However, that's just going to take time and development and engineering and just acceptance of how that this is going to be a legitimate way to do things, not the only way to do things, but a legitimate way to do things. That's just going to take time. Like PayPal recently integrated or announced that they're going to allow for crypto purchases. It's probably just Bitcoin, Ether, and maybe like USDC or something. Mm-hmm. But like we just need to go through this normalization process where like the on ramps and acceptance of this new digital world is okay, and that people when they say like, yeah, I put up my house as collateral, people aren't going to look at you weird as like, hey, what the hell does that mean? Or excuse me, put up my collateral inside of Ethereum. Like when the people don't look at you weird, people can be like, oh, okay, that you're one of those guys that did that.
Theoretically, though, in that example, I could get a home equity line of credit using the blockchain. I don't need anyone's approval to do so. There needs to be verification that I have equity in the home, right? Like,
well, you do need approval from Compound, right? Compound needs to enable you to allow that collateral to be collateral. But then other than that, yeah. Mm-hmm.
A lot of the mechanisms in the traditional system right now where someone says yes or no, you can or can't do this, like some of that would go away as long as the baseline stuff is shown to be true.
Yes, right. And that is the whole vision of these entire systems, right? And this is the sentiment echoed by the book, The Sovereign Individual, where it says like the technology that we've seen, like the smartphone, microprocessors, cyber currencies is what he called them in his book because he wrote it in 1997. Now we call them cryptocurrencies. What they allow for is a global nation of people that work together in a similar economic substrate, which I'm thinking is Ethereum. Bitcoin is welcome to come, but because Bitcoin isn't expressive, the economy is going to have to be built into this new paradigm that is Ethereum. And it's just a matter of just like being able to put up your collateral inside of this protocol and then transact with somebody in some other country with that value. And then they can transact with somebody else in a different country. And we're breaking down borders, right? And so what we really need is a way to get assets onto Ethereum that don't necessarily require the legal stamp of approval of some sort of centralized court system that says that they will back up this claim of truth, and instead do it in a peer-to-peer fashion. That's going to be the hard problem.
How long until you think you could go off the grid of traditional banks and be bankless?
Well, again, it depends on what you are trying to do. If you're just trying to hold your money, as in your stable coin or your crypto asset like Ether or Bitcoin,
let's say you want to participate in the economy like a normal person would. Mm-hmm. I'm an American. I got a house and a dog and kids and expenses and a job. I want to do it without a traditional bank account. I want to have self-sovereign capabilities. I want my money to be in my wallet that I own and I have access to, yada yada.
Without like hugely compromising your quality of life and making things cumbersome and everything like that. Yeah. Well, so like there are also tools that allow you to go spend this money like in a store, right? So Monolith, which disclaimer, they're a sponsor of the Bankless pod. They have this DeFi card, right? And it's a Visa card, and it speaks to your DAI balance in a smart contract wallet. So you can go buy your groceries, and then it makes a transaction on Ethereum and pulls out DAI to spend that at the grocery store. Now it does its clever engineering, right? Where the grocery store isn't receiving DAI, they're receiving dollars, but the DAI is being sold for dollars and cents.
Yeah, something's providing the bridge.
Right, exactly. And that's what they have. So that's a bankless tool. At the end of the day, that is settlement with the physical nation, the nation state, because the dollars are making a transaction on the system too. What would be really dope is if the grocery store or your coffee store just accepted crypto directly. And that's just a slow process of network effects, right? That just
the merchant processors have to be the ones to say that. Like Square not only needs to offer Bitcoin purchases through the Cash App, but they also need to offer that as a form of payment that they can seamlessly provide in their merchants who accept payments in person, and et cetera.
Right. Like a business can't just like throw up a QR code and say, okay, just like send me your Bitcoin here, or send me your DAI here. Because they need like accounting, right? They need to be like, okay, this went with this transaction. This transaction was paid for. And so like it can't just be like that simple, but that's also not really that hard of a problem, right? Like we can solve this problem relatively easily.
One more thing I want to wrap up with. I think Josh would kill me if I didn't ask about it, but how is all this affecting the network congestion in the Ethereum ecosystem? How badly is ETH 2.0 needed? Where is it? I've heard about Ethereum 2.0 like since I got into crypto.
Yeah, sure. So I'm not a ETH2 developer, but I do talk with them a lot. So to answer your first question, net congestion on Ethereum is really bad in a congestion perspective. So like transaction fees are really high. And so you got to pay a lot to get included. At the same time, like this is also good, right? Like I would prefer this to be true rather than to be like EOS or Cardano or Litecoin or something that
empty block after empty block.
Empty block after empty block. Like high transaction fees suck, but they are better than no transaction fees.
For what it's worth, what is the relative high transaction fee? Because I remember a time in 2017 when Roger Ver, well, at least I'm assuming Roger Ver was spamming the crap out of Bitcoin networks, and it was also $18,000 Bitcoin, and it was like $100 to send $100. You know, like you had to spend a fortune to spend Bitcoin. Ethereum's not to that scale, right? Is it like what kind of fees
it
are we talking
depends
about?
because like one transaction on Ethereum you can't compare to another, right? So like you have this simple send of Ether, which takes 21,000 gas, and that's like 10 to 15 cents right now, which is still the highest it's ever been. But then you can do something more complex where like people who are liquidity mining comp,
they're doing it for all the time over and over again. So
right. Just managing that contract and withdrawing comp. So like you accrue it in the background. You don't need to make constant transactions, but the redeeming it costs $10. So you would need to like earn more than $10 worth of comp to even make this like legitimate in the first place.
I see.
And then it's also denominated in ETH price, right? So there's both congestion and the price of ETH. Unequivocally, this has been the most congested the Ethereum blockchain has ever been for this long amount of time. It's passed Bitcoin, I think for 10 days in a row now in daily transaction fees on the Ethereum network. So people are spending some money, but like again, like this is good for the health of the network, right? This is what we want. Turning to your question about ETH 2.0 and when's it coming? There are now 2 test nets that have cropped up in the last month and a half, I think. So people are running validators on test nets and different clients are plugging into that. And so just as a refresher, Ethereum needs different clients, right? There's multiple different clients, and that helps with the decentralization of the network because I just triggered Siri. Because we need more clients, because if one client goes down, the other clients will keep it up. And we've seen this happen before with Ethereum 1.0, where there were 2 main clients at the very genesis, and one got hacked, or there was an exploit, and then the other one kept the network up while that one got fixed. And so different clients, I think we're up to 3 or 4 now, have plugged into the Ethereum 2.0 test nets. And so there is never ever going to be any official date, but we're thinking by the end of Q3 2020, and we is actually not me. I don't really speak for anyone, especially not the developers. And the developers, if they were on this, would never say anything about when the date is. But you can kind of see the writing on the walls, and people are starting to buy and produce more staking nodes, because you need a node to stake, and so like that you looking at the market. There's been more demand for staking nodes. There's been more chatter about it.
That's a specific hardware that people need.
Yeah, well, not a specific hardware. You just need a decent computer. It's just like the bare bones computer, like a $100 to $300 computer.
But are people making like fine. The Casa node equivalent?
Exactly. Yeah, we call them DApp nodes.
Okay.
But I think you can even do it on a Raspberry Pi. But you need something like that. You don't want it to be like on your normal computer, because it'll eat up your bandwidth.
Right.
But the point is excitement and sentiment around Ethereum 2 is improving. And that's really the best thing I can do for you when it comes to estimating its launch date.
Yeah, that's fine. That's kind of what I was looking for. Finally, is Coinbase playing into the whole DeFi thing with these 18 coins they're talking about? I know myself and a lot of people had not heard of several of them, but it seems like all the ones I had heard of, many of them were based on this DeFi conversation that we've had today, whether it's synthetics or Ren or comp. do you think this is they're making a firm play towards the Ethereum ecosystem and DeFi in particular here?
Yeah, absolutely. So some of those are definitely shitcoins. But some of them are, I would say, are also legitimate. Like at least innocent until proven guilty, at the very least. Part of this whole the Bankless thesis is like what I said, the protocol sync thesis. And so centralized companies like Gemini and Coinbase are going to be building upon some of these on some of these protocols. And I think the first step is just issuing the token on the exchange and allowing the token to be tradable. We had the Winklevoss twins on the Bankless podcast a while ago, and we talked to them about like, okay, what do you guys think about the protocol sync thesis? And they then just to recap, the protocol sync thesis is that centralized companies, centralized businesses will build on top of protocols and use the protocols as like a value added service for their customers. And so like in Gemini, the theory would be that they allow you to open up a MakerDAO vault, or allow you to lend or borrow throughout Compound, and they just build an interface for it, and then they take a cut. And so like when Compound does something really favorable to the DeFi world by listing the tokens and making them available for exchange, I see that as like the first step of this whole protocol sync thesis. You can already get an interest rate on USDC inside of Coinbase. It's super low, and it's definitely not correlated with the interest rates that you can get inside of DeFi. But I think it's just a first step. So we're seeing early premonitions of this coming from the exchange world.
Well, that sounds interesting to me. David, I appreciate you coming on. Everybody go to twitter.com/trustlessstate. Follow David at trustlessstate. I know I am, in order to try to keep up with what's going on in this ecosystem because it is moving fast. Also, POV Crypto Pod. Listened to a couple episodes so far, and it's been very enjoyable to see the back and forth between them. And then let's see, what other links do you have for me? Anything? Go to Bankless on Substack if you want to get the real nitty gritty on everything. They'll keep you informed. I'm certain of that. And I appreciate you being here with me. Go to letterstatus.com to check out this episode and more. Be sure to rate us on iTunes and all that crap. David, you want to leave us with anything?
Yeah, no, just appreciate you bringing me on here. And I'm going to guess that your audience isn't typically exposed to deep, crazy Ethereum stuff. So I appreciate the opportunity.
Well, we're always open to it. I like to learn, but sometimes it's hard to filter through and find the right people to come on and talk about something. So it's really easy for me and Josh to give our own perspective on stuff. But there are certain things where we know that we have things that we can learn. And Josh gets around in terms of knowing that stuff, but he also has his opinions about it. I had not done enough of a DeFi deep dive yet, so I wanted to have somebody on to help me with that. And I'm glad that you were here. So I appreciate you doing so. And I'm sure everybody else does too. Tell David thanks if you did. And we'll catch everybody next time.
Just run dry in a house of cards. I feel the breeze wound so tight.